Good morning from London. I'm Anna Edwards alongside Guy Johnson and Lizzie Burden. We're an hour away from the opening trade. Here's what you need to know. Gold hits $4,000 an ounce for the first time amid a US government shutdown and political crisis in France. Tech sector jitters weigh on global stocks. Worries include lofty valuations, ballooning AI spending and circular deals. The latest, Nvidia plans $2 billion of financing for Musk's xAI. And security company Verisure gets set for its €3 billion IPO today in Stockholm. It could be the largest European listing since Porsche. We will speak to the CEO in just a few minutes.
Well, the fears of an AI bubble are swirling again, Anna. We saw the fatigue in US stocks yesterday. It's already weighed on Asian equities this morning, and futures treading water on both sides of the Atlantic already. We have that political uncertainty continuing around the world, but particularly in France, weighing on euro-dollar at a 116 handle. And on the flip side of it, gold smashing through that $4,000 an ounce level now. The countdown to the opening trade starts right now.
Gold is a very excellent diversifier of the portfolio. So if you were to look at, just from the strategic asset allocation mix perspective, you would probably have something like, as the optimal mix, something like 15% of your portfolio in gold.
Ray Dalio, Bridgewater founder, talking about gold. He thinks circa 15% is the right number for your portfolio. Is that the right number? The melt-up continues. Why the melt-up continues? Well, there's a number of different factors behind that. But certainly this debasement trade narrative is doing the rounds right now on Wall Street. What does that tell us about the wider markets? Is there a connection? Is it to politics? Is it to what is happening with the dollar? Lots of things going on here.
Yeah, absolutely. And Guy, let's just remind ourselves that it was only March when we went over $3,000 a troy ounce. So yeah. 3 in March, 4 in, where are we, 8th of October. This is gaining momentum, it seems. You mentioned the number of reasons for this. Shall we count the ways in which we love gold right now? The Fed rate cut narrative, of course, continues. We have fears around the dollar in US politics. The shutdown continues. French politics to the fore. Central banks are buying. ETFs are on the rise. And Ray Dalio makes the point that this is just being seen by many as a really good, excellent diversifier of portfolios, as a store of value. He makes the comparison with the 1970s. And it is worth reminding ourselves that there have been at least periods in history where we've seen this correlation with stocks before, where they've both gone up together.
But what happened in the early 80s? Straight down.
Right, yeah. So it doesn't always hold either.
Well, to continue the historical theme, it crossed the $1,000 level in the financial crisis, it crossed the $2,000 level in the pandemic, and then it was the $3,000 level in the run-up to the Trump so-called Liberation Day. So it does follow history, gold.
The question is, what happens next? Gold has a history of going up very kind of fast and then coming down very fast. How much of a diversifier is this? Is this a safe haven asset in the same way that treasuries are? I think that's a key question that a lot of people need to ask. Are they asking? I think is the question.
Well, one of the features that they both share as havens, which is kind of strange, I suppose, well, maybe a reason for being havens, but also a reason why they don't act like it in the short term, is large amounts of liquidity. So often at times of stress in markets, you'll see markets sell what they can and not necessarily what they want to. And to your point, Guy, that often means a very, fast elevator down for gold. Yeah. That can be the way things go.
Escalator up, elevator down, elevator shaft down. Let's talk about France. What are the political reasons why we're maybe seeing gold doing what it's doing right now? So the 48-hour period, the clock is ticking. We work our way towards the end of that. At the back end of today, we are going to see negotiations between the governments. Lecornu, Elizabeth Bourne, I think, is involved here, between the government effectively and the Socialists today. What I think is interesting in what is happening here is, apparently, according to the French press, there is a suspension of pension reform being talked about, which I find absolutely startling. This is a key policy of the Macron administration and raises, I think, 2 really important questions. A, how desperate is Macron right now that he's prepared to torch this key element of his presidency? And the second question is, if you can't do pension reform, how do you get France's finances back in order?
Well, what I think is interesting is that you've got not only his enemies swirling and putting up the pressure, trying to take advantage of the chaos, but also his allies, long-time allies, like his first Prime Minister, like Gabriel Attal, another former Macron Prime Minister. But to come back to the policy point, some of Macron's allies considering backing the Socialist proposal of a wealth tax, even if not a long-time alliance with the Socialists, at least trying to get some progress on that aspect of policy.
So I think the problem here is that basically everybody's looking at 2027. Everybody's looking at the elections for the presidency in 2027. Now, they may come earlier. We'll wait and we'll watch and see what happens there. But in the interim, nobody's prepared really to deliver a compromise that would allow the Macron administration to continue, because everybody's just looking at the bigger picture. Everybody's looking at the presidency. They don't want a deal because they want the presidency.
The incentives are misaligned to allow any kind of deal under Macron to be achieved if Macron doesn't have that underlying majority, which he doesn't have, but then neither do any of the other parties, to your point, Guy. Now, I was looking at some research by Berenberg, which was reminding me of some other really interesting outcomes that we could see here. Of course, we know about the budget emergency options rolling over the 2025 budget. There is also the option for the president to just impose a budget, politically extremely risky. Does he have that kind of capital? Perhaps not. But Article 16 allows that. And there is also the prospect of EU pressure. Now, the EU started the procedure, excessive deficit procedure against France, and the next staging post for that is the end of October. That won't answer anybody's questions, but it could give the political opportunity for Macron to blame Europe for tough decisions at home, if he was looking for a reason to try and push anything through. But the reporting around the pension perhaps suggests he's not.
Well, just going back to Edouard Philippe, the compromise that he's suggesting is that Macron should resign, which of course Macron says he won't do repeatedly, on the condition that he gets the backing for a budget being adopted. Can you see Macron doing that?
This is the problem. As you say, everything is misaligned in terms of getting a deal done here. So where does France ultimately go? The next logical step would appear to be parliamentary elections. But again, does that solve anything, or is that just an exercise in kind of futility as we await 2027 elections?
We've been through getting a new Prime Minister. We've been through a snap vote. The only option left, surely, is for Macron to resign. That hasn't been tried.
You're going to Paris, aren't you?
Later today. Indeed,
big bag. Lizzie's got a massive suitcase.
But
She's ready to go.
Before she goes to Paris, we need to talk about tech deals, Lizzie, because this has become a market preoccupation.
We do. Well, talking of my circular trips to Europe, circular trips round the AI universe, we have another deal on the table, and this is XAI, Elon Musk's AI startup, of course, going to be backed by Nvidia. Our source is saying that this is going to lift the ongoing funding round to $20 billion, so as much as $2 billion from Nvidia, and it's to buy Nvidia processors. So it adds to this worry that everyone along the supply chain is just buying the next stage along the supply chain. And yes, everybody could win big, but if everybody loses, everyone could lose big together as well.
I asked one of the LLMs this morning if it could draw me a diagram of the circularity. It struggled to deliver that.
The Bloomberg terminal has the efforts of the very unartificial intelligence staff here at Bloomberg.
Just trying to keep up with the connection. The story yesterday was Oracle, though. And razor-thin margins because it's trying to, in its kind of renting out of Nvidia chip model, and that clearly is not producing the kind of returns. But Oracle, remember, went up an awful lot. We got very excited. The stock dropped 7% yesterday, but then bounced into the close.
I was interested in the Oracle line. I was also interested in the Ares management line. You know, this is a credit business that has been investing a lot in data centres, and even they say the risk is that there is overcapacity in the build-out, and you know, people at the forefront of this might know.
OK. We've got an IPO today. It's quite exciting. This doesn't happen very often. It used to happen a lot. It happens a little less these days. Fundraising stateside to fundraising in Sweden. Sweden's an interesting part of this story. Verisure is today leading Europe's largest IPO in, get this, 3 years. The security system firm begins trading in Stockholm this morning. There are apparently actually going to be fireworks. The CEO of this business is Lally, and joins us now. He joins us now. Austin, thank you very much indeed for taking the time to join us. I noticed the pricing today a little below maybe the top end of the range that you put this business to market at. What does success look like today for you?
Actually, success for us is really about the long-term growth prospects of the company. I mean, we're excited about the IPO. I mean, it's a big day for us. I mean, for me, it's 11 years plus as CEO. We've been on a journey back to this day to return to public markets. We always knew that with the scale of the company and the internationalisation of the footprint, that the natural home for the company would be back in public markets, and so we're here. But it's a waypoint on a journey, because Verisure, it's always been a long-term growth story because of the penetration of security being so low in the European markets.
Good morning to you, Austin. Very briefly, what has been your one-sentence pitch to investors? What's the pitch that's gone down best?
Yeah, the penetration of security systems in our footprint is only 4% of homes and small businesses, and so there's a huge runway of growth ahead.
Austin, are you considering at all widening the investment base after today? Maybe would you look at the US as well?
Well, I think we've been delighted with the response on this transaction. Very strong support here in the Swedish market, but also very strong support among international investors. I think we're going to end up actually with a very balanced investor base between Swedish institutions and international institutions that are looking at the long-term growth prospects of the company.
Austin, we have a lot of conversations with private equity at the moment about why private equity is struggling to deliver exits. Why are you able to do what others apparently can't? Why are you able to deliver an exit for your private equity backers in the way that other firms are struggling to do? Is there a sort of secret sauce here that you have that others don't?
I think it comes down to the quality of the asset and the length of the track record. I mean, we've partnered together, for more than 11 years. I mean, over that decade, we've actually tripled the size of the portfolio. We've quadrupled the revenues. We've quintupled the profitability. So it's not a short-term story.
Yep.
I mean, we're marketing the company on the back of a decade plus of double-digit recurring revenue growth. And I think that combination of track record and credibility, plus the growth prospects ahead, that basically makes it a high-quality asset and a lot of investor demand.
Absolutely. So there's a lot of investor demand. Can I just come back, therefore, to my first question about what success looks like today? Would it be desirable to have a big pop in the share price? Is that what you're looking for here in some ways? Is that what you think the whole industry, and I'm talking here more about the private equity industry than maybe the security industry, is looking for here? A sign that IPOs work, that they deliver upside. Are you the kind of poster child for that? Do you need to deliver that for the wider picture, do you think, today?
I think it's really about Verisure, not about the wider market. And it's not about today. It's about how the company is trading through the rest of the year, and then how the company is trading next year and the years beyond. I mean, this is a long-term growth story. We don't focus on words like pop. What we focus on is basically serving our customers better. And we think if we do that, the company will continue to grow. And we think our investors will be happy and they'll stay with us for a long time.
Yes, and picking up on Guy's question, Austin, I mean, the private equity industry might be watching this very closely, as he suggests, but actually the buyout firm that I think is your majority owner, Hellman & Friedman, is not taking the opportunity to sell. Can you tell us why is that? And does that leave an overhang on the stock, an expectation that at some point they will want to sell?
I think for Hellman & Friedman, it's been a long-term partnership. I mean, I've been with them for more than a decade. The reason they're not selling is that they believe that there's a very strong value creation ahead, that this penetration opportunity is strong. Actually, I'm not selling shares at the IPO either, and it's because of my belief that this penetration opportunity is something that we can seize. I mean, one thing that we're proud of is that we're actually taking 2/3 of the market growth in our footprint. I mean, Verisure is basically the market maker, and that portfolio has tripled in a decade, as I mentioned before, and yet, when you look at the penetration opportunity that remains, so much growth ahead. And so this combination, again, of its track record, but it's also growth potential, and you put the two things together, and that builds confidence, actually, in the future value creation.
So, Austin, what are you actively doing to make sure that going public doesn't change the culture in your company?
Yeah, it's a super question, Lizzie, thank you. Well, first of all, we've tried to act like a public company for a long time now. We knew that one day the home for the company would be back in public markets, and we've held ourselves really to those standards. We have a very strong DNA. We're very focused on serving our customers better, on bringing differentiated innovation to the marketplace, on strong category creating marketing. I mean, we're going to spend, I think, annualized 300 million euros this year in demand creation marketing. I mean, we spend typically about 7% of our revenue to make the market. In fact, we operate really like an FMCG company, although we're in the services business. That category creation, that sense of ownership and drive, that's carried us over the past decade, and we're going to continue it afterwards.
Austin, nice to speak to you this morning. Thank you so much for joining us. Austin Lally, the Verisure CEO. He will be keenly watching, we will be watching how the share price opens in around 45 minutes' time. Talking of the market open, we'll also keep an eye on the auto sector. Coming up, BMW is called to open lower after the auto giant lowered its outlook. We will check on that car maker and others at the start of trading. Plus, we'll also have an eye on UBS amid a report the Swiss lender could be overexposed to a risky asset. We'll talk about that. Up next, Jamie Dimon says that AI cost savings now match the money being spent. We will hear from our exclusive interview with the JP Morgan CEO. If you have any questions for our guests, please get involved in these conversations. IB plus BBTV Go is the function on the Bloomberg terminal. This is Bloomberg. Welcome back to the programme. Still 40 minutes until the start of equity trading. The futures picture looks a little flat this morning. US futures flat to positive. Talking of the US, Jamie Dimon, the CEO of JP Morgan, says the bank is spending $2 billion a year on AI and expects that to deliver billions more in cost savings. Dimon, who has been one of the most outspoken Wall Street voices on the opportunities that AI offers, spoke exclusively with Bloomberg's Tom McKenzie at the bank's Techstars conference in London.
We've been doing AI since 2012, so people think it's like a new thing. Gen AI is kind of new, but not all of AI. We have 2,000 people doing it, spend $2 billion a year on it. It affects everything: risk, fraud, marketing, idea generation, customer service, and it's kind of the tip of the iceberg. And so, we're deploying it. Every time we meet as a business, we ask, what are you doing in AI? What are you doing to serve your people? Why can you do better? What is somebody else doing? So we're freely deploying it and safely. We have a lot of rules and regulations in place for our own data and how we use it, et cetera.
Is it having a material impact on revenues for JP Morgan? If not now, then when?
So we have shown that for $2 billion of expense, we have about $2 billion of benefit. Some we actually can do real detail. We did this, we reduced headcount, we saved this time and money, we reduced errors. Some you can't. It's just improved service, something like that. It's like almost worthless to say what's the NPV, but we know about $2 billion of actual cost saves. And like I said, I think it's the tip of the iceberg. We're getting better and better at it. We know how to do it. As the managers learn how to do it, they're asking more questions. Why can't it do X and why can't it do Y? And then I don't have my phone here, we have a suite, an LLM suite on internal data to do research and summarize reports and scan contracts and do things like that. 150,000 people a week use it, so it's quite productive.
More of your employees are using the agentic AI.
Our own LLM, and agentic is just starting. But that will be deployed over time too. But it's also being used for coding. I mean, it's being used quite broadly now, and like I said, part of it is getting your mind working around how you're going to use this thing, and so our managers and leaders have to do it.
If you look out 5 years, are there more jobs in banking as a result of AI or fewer?
I think people shouldn't put their head in the sand. It is going to affect jobs. So think of every application, every service you do, you'll be using AI. Some to enhance it. Some of it'll be you doing the same job. You're doing a better job at it. There will be jobs that it eliminates. But you're better off being way ahead of the curve and retraining people. So we retrain and redeploy a lot of people. So for JP Morgan, if we're successful, we'll have more jobs. But there'll probably be less jobs in certain functions.
When you look at the spend on AI, infrastructure, chips, OpenAI, it's not making a profit. Loss-making, deals of about $1 trillion this year. The hyperscalers, the spend there. What is your reaction when you see those numbers crossing? Are you comfortable with that kind of spend on the infrastructure around AI?
It's a lot. I'm not sure it's all ever going to be totally spent. I think when you look at big tech, like tech that happens like this, and you go look at cars, you look at television, you look at internet, big money's got spent. There were a lot of losers, a lot of winners. In total, it was productive. So even take the internet bubble. Remember that blew up, and the amount of people. You and I can probably name 100 companies that were worth $50 billion and disappeared, but out of it came Facebook, YouTube, Google. So there will be some real big companies, real big success. It will work, in spite of the fact that not everyone who invests in it is going to have a great investment return.
So that was the JP Morgan CEO, Jamie Dimon, speaking exclusively to Bloomberg's Tom McKenzie, who joins us now. Tom, you've had lots of tech conversations this week. You've been to Italian Tech Week last week. What's the industry argument here against circular financing? We heard a bit of it there.
Well, it's interesting. Both David Solomon, of course, of Goldman Sachs last week, and Jamie Dimon yesterday, not expressing huge concern about the amount of financing and the amount of spend that's going on, whether it's infrastructure or the chips or the data centres. And I gave those examples, of course, to Jamie. And he said, look, he echoed what we heard from Jeff Bezos last week at Italian Tech Week. He said there will be a loss of capital for some investors, but overall this will be net positive. There will be new and significant companies that will come out on the back of this, and that will be net positive for the economy. So he's seemingly relatively relaxed on the spend that's coming through. He talked about the fact, of course, they continue to invest in JP Morgan themselves around AI, $2 billion specifically on AI. They spend almost $20 billion investing in tech, but on AI, $2 billion, and that they're making that up. So the revenues coming through as a result, the gains coming through as a result of that investment is now matching that $2 billion. He says, again, he thinks that's just the tip of the iceberg for them. And then, of course, we talked about jobs as well. And he thinks if JP Morgan continue to grow, then, in fact, their headcount is going to increase. Even in some areas, you will see job losses.
Two takeaways, one of which is you can wear jeans and no tie at 69, which I think is...
And if you're Jamie Dimon.
Of course.
And it's a tech conference.
I think these things should be more ubiquitous.
Agreed.
The second thing is, presumably they lend money into this. So, to a certain extent, they are part of the narrative in this process. And also, they specifically, with the banking industry, the credit industry as a whole is involved in this process. But it is starting to look circular. So, the latest deals we've got, what is happening with OpenAI, I think is really interesting, and the XAI deal. But it also comes back to the Oracle. I know we'll talk about Oracle in just a second. There's this whole kind of financing story where the XAI deal is fascinating because they're going to rent back effectively the servers. But the margin story coming out of Oracle yesterday indicated that business is really hard to make work. So kind of the cracks beginning to appear in is the XAI deal just kind of that whole story on steroids.
If you needed a reminder that this is an arms race, then XAI and Nvidia provide that once again. This is an arms race for a as yet largely unproven technology. This will be a special purpose vehicle, debt and equity, around $20 billion US. And yes, to your point, there will be GPUs that will be bought from Nvidia by this special purpose vehicle and then rented out for 5 years to XAI, a company that is losing $1 billion.
When I read an article that's got SPVs and creative financing solutions in it, it does start to ring a lot. Definite flashbacks.
OK, here's a different take, though. Lisa Su over at AMD, she wasn't talking about any of these specific the specific deals, but she called this the circularity of it all. She called it a virtuous positive cycle.
Yes, and we'll see if that pays up. As did Brockman, of course, who was sitting alongside her in that interview with Bloomberg. No one within this space is walking back from these commitments, and no one is showing and expressing deep concern. One line from this Bernstein analyst that stood out to me this morning on Sam Altman, because he's tied up in this, of course, and central to that. Sam Altman has the power to crash the global economy for a decade or take us all to the promised land.
Wow, there you go.
Where's the promised land?
I'm keeping my fingers crossed.
Artificial general intelligence.
BTEC Europe anchor Tom McKenzie, of course, with us after that interview with Jamie Dimon and all things technology this week. Tom's next episode of Bloomberg Tech Europe airs this Friday, 6:30 a.m. London time. We'll have more on the global macro story when we come back. This is Bloomberg.
OK, 30 minutes to go until the opening trades. Futures not really doing anything in a hurry. We're not going anywhere in a hurry, as you can see. FTSE's up by 1/10 of 1%, CAC's up by 1/10 of 1%, Euro Stoxx 50 down by 1/10 of 1%. Yesterday was a really interesting session, in as much as we started to see some maybe more substantial cracks appearing in the AI financing model. And you kind of wonder whether that's got legs and whether or not that bleeds back into this Wednesday session from the Tuesday session?
In our diversified portfolio of assets to check this morning, stocks not doing a whole lot, bonds not doing a whole lot. A lot of the attention is on gold, which we'll come to shortly. But this is the picture for bonds. We're seeing a little bit of buying, very much at the margin on European debt. And just a quick spread check, 85 is still the spread of France over Germany in these European bond markets. With France in mind, then, today marks President Macron's deadline to save his government after his Prime Minister quit. This as Macron's rivals turn up the pressure on the French president, demanding their choice of either Prime Minister, snap election, and even Macron's resignation. Jean Dalbar from Bloomberg Economics joins us now with an update from Paris of what is the latest. So the clock is ticking on Macron's own self-imposed deadline here, Jean. Can he save his government in time?
Well, this is increasingly unlikely, but there is still some hope. Why? Mainly because the centre-left and the centre-right will lose a lot of seats at Parliament if there were to be new snap elections. So they are incentivized to gather and to form a new minority government. So that's a possibility. And one key driver to watch would be a potential suspension of the pension reform, which is a key part of the economic platform of the Socialist Party. So that would be something to watch to understand if the negotiations are going in the right direction or not. But if we take a step back, the situation is very, very complicated because parties are reluctant to compromise just because presidential elections are looming ahead in 1.5 years' time.
Jean, there is this assumption in the market that France is okay because it's part of the Eurozone, that it has the ECB's backing, that if there's real trouble, the Eurozone will step in and rescue it. My question is France too big to fail or too big to rescue?
Yeah, so that's a very good question. I mean, at the moment, there is no contagion. There is no spillover from France to other European countries. So it remains a domestic issue. And we know and we understand that the ECB could be ready to step in only if France is committed to some sort of fiscal sustainability. And that's what France is doing. It has been engaged into a 4 percentage points of GDP consolidation journey over 5 years' time. And it's going pretty well because in 2025 it has already delivered its consolidation. Now the focus turns to 2026 and it should increase its consolidation. And that's one of the reasons why the previous government has collapsed. So that's precisely the point, to be able to deliver the substantial consolidation that could open the door to a potential ECB intervention should it be needed, should it be required, which is absolutely not the case at the moment.
OK, Jean, we thank you for the update. Jean Dalbar from Bloomberg Economics as we count down to President Macron's self-imposed deadline tonight. Meanwhile, across the pond, President Trump's threatening to block back pay for some federal workers once the US government reopens, saying some, quote, don't deserve to be taken care of. The White House Budget Office argues a law guaranteeing back pay is flawed, but Democrats call that interpretation an outrage and illegal. Now, that comes as gold hits another record high on market angst linked to the shutdown, and we can get the latest from Bloomberg's Valerie Teitel. Val, we're past that 4K level. What's next?
We have passed the 4,000 level for the first time ever for the yellow metal. Gold taking another leap higher today, up another 1%. Lizzie, gold has now rallied over 20% since mid-August, and you can tie it perhaps to the Fed's dovish shift at Jackson Hole. Perhaps what gold is telling us is that the Fed is putting its pedal down a bit too aggressively at the wrong time. But there's a lot of hot takes on what's caused the recent rally in gold. We heard from Ray Dalio just yesterday calling that it's a good diversifier for a portfolio. But take a look at how gold has acted this century. Honestly, back in 2000, you might as well shoved it all into gold and turned your Bloomberg terminal off, because it has been up over 1,000% since the turn of the century, way outperforming stocks in that time. But the interesting thing about the session yesterday, Lizzie, is gold was rallying whether equities are higher or lower, whether Bitcoin is up or down. And that is something I think is taking away as a very decent momentum trade. It was higher yesterday, even though the S&P 500 snapped its 7-day winning streak, its longest winning streak since May. And remember, the equity market has now added 16 trillion since the lows back in April. We also heard from Ray Dalio saying that this market does look frothy, but looking ahead, this gold rally really looks unstoppable at this time.
Val, thank you very much. Bloomberg's Valerie Teitel. Let's pick up on that theme in our next conversation. Nicholas Brooks joins us, Head of Economic and Investment Research at Intermediate Capital Group. Nicholas, very nice to have you with us. Let's start with gold, shall we, given that we've gone over $4,000 a troy ounce. Valerie talking about the strength that we've seen there. Are you convinced is now still a good time to buy into gold?
I think structurally, I think gold will be supported. I mean, whether it's moved a little too fast since August or over the course of this year, up over 50%, it's hard to say. But if I look on a medium-term basis, I think, having gold in a portfolio, again, it depends, on your risk appetite, but having gold in a portfolio makes sense as a hedge against, the debasement effectively of fiat currency. And I think that's a concern of investors today. Given the amount of debt that the U.S. and other key governments have. And gold is looked at as, the safe haven, the ultimate store of value.
Right. And so it's about debasement of fiat currency, is it? Or is it about specific national policies that maybe should alarm bond vigilantes more than they have done? I mean, what do you think is really driving this?
Yeah, I mean, it's a good point. I think it's all linked to some degree. So I think the idea of currency debasement, the idea that, let's say, the Fed starts printing money again and starting to fund fiscal deficit through printing, is related to policy, is related to tariffs, is related to geopolitical risk. It all comes back to, in my view, that gold is looked at as an alternative currency. And all of these other factors that are driving gold, including, central bank diversification, are related to that.
What are the implications of gold replacing the dollar, therefore?
Well, I don't think gold is going to replace the dollar.
But in people's minds as a place to go when they require safety, as a hedge against risk. Normally, at this point in the cycle, you'd be going, right, I'm buying the dollar. All hell's breaking loose in Washington, I buy the dollar, ironically. But we're not doing that.
Exactly.
We're buying gold. So what are there long-term implications of this?
Yeah, I think the world has changed. I think it started back when we, saw the first bouts of, QE back in 2008-9.
Yep.
Then we saw again another huge bout of QE coming through in the, during the COVID crisis. I think that changed the psychology towards the dollar. And then on top of that, this has been building for a generation, the amount of debt that the U.S. and other major developed economies have. Sure. The typical story, aging populations, et cetera. So the question is, structurally, do you want to have some diversification away from the dollar? And I think a lot of investors are thinking yes.
Is this a message to the White House? Don't pick a sycophant for the next Fed chair.
It certainly is. It certainly is. And related to all of these things, again, is Fed independence, going right back to this idea of, are they going to print money in order to keep nominal bond yields down? Because so far, the U.S. bond market has been pretty calm. Yeah. But we all know how bond markets work. They're really calm until one day they're not, as we found here in the UK during, Truss's famous mini budget. I think in that type of scenario, which is possible given that at this point there doesn't seem to be any fiscal consolidation going on in the U.S., that, the Fed, independent or not, would probably feel that it needed to stabilize the bond market by intervening. And at that point, that would be viewed as inflation. Intervening by QE.
Okay.
Yeah. Buying. Yeah. And then, ultimately that causes medium-term inflation expectations to rise, real interest rates fall, and the dollar weakens.
Nicholas, you take me to the UK, and there's an embarrassing headline that's just crossed the terminal, which is that the UK Statistics Office says an error in the 2025 public finances data has occurred. They say that it's because of the VAT receipts being wrong, and that actually there could be a 200 million to 500 million error in the public sector net borrowing figures. I wonder if that matters at all.
That was monthly.
Yeah. If that matters at all when you're looking at Rachel Reeves as we head towards the next UK budget, or if you already think it's absolutely inevitable that she's going to have to either break her fiscal rules or raise one of the three main levers of tax. How are you feeling about UK debt?
Yeah, no. I think ultimately Rachel Reeves is going to have to either raise taxes, find some place to cut spending, or change her fiscal rules. I think that is inevitable. It seems unlikely, though in my view she probably should, but that's a probably a non-consensus view that she should probably change her fiscal rules to some degree.
Would the market forgive her?
I think it depends how it was done. That's my view, would be that if it's putting more flexibility in. It's not saying that we're going to run much larger deficits, for the foreseeable future. We, again, learned from Liz Truss that that's not a good thing to do. But I think putting a little more flexibility in there, because what I think they've done and what she's done, or what I think the government has done, is it's sort of setting up a target for investors. It's like fixing a currency incorrectly, and gives speculators something to go after.
Talking of debt, France, Nicholas, your thoughts on the French? What is the fear that investors should be thinking about here? I mean, I don't know if that's the right word. What is the outcome that maybe is not the base case, but what's the worst that could happen?
Okay. So I'd say there are a lot of potentially bad scenarios, but I would say from an investor's point of view, probably the worst case scenario would be far left coming into power. Now, I think the likelihood of that is incredibly low.
Right.
But if they were to follow through on the policies they say they'd like to follow through on, it would be incredibly damaging to the French economy. And we probably would have a debt crisis, or we would at least have to have the ECB intervene very aggressively to bring spreads down, and we probably would have a change in government quite quickly.
Would that come with conditionality?
I think it would. I mean, in some ways, the way I look at the ECB in this kind of situation is very much like the IMF. It's there, in a way, to give governments an excuse to do the right thing. Because the reason so many governments aren't doing the right thing, it's because voters don't want it. And if they want to keep power, they need to keep voters happy. But the minute you're in a crisis situation, you can say, well, the IMF told me to do it, or the ECB told me to do it. So the ECB becomes the bad cop, but it allows good policies to be put through.
It's the end of your political career at that point. But,
generally you're done, but then new people can come in.
Just in terms of the short term, there's talk in the French papers this morning about getting rid of the pension reform that Macron has pushed through. What do you think the implications of that would be? Is this already a step down that road, that France is incapable of fixing its public finances? It can't do pension reform, one of the big set pieces of that structural realignment. And ultimately, that takes us one step closer to the scenario you are painting a picture of.
Yeah. I think it does. I think, my sense, again, one shouldn't be predicting things that will probably be coming out later today. But my instinct is that Macron...
So morning TV.
Macron will probably not go along with it, just because it's so core to what he's done. I think that he'd rather see a new parliamentary election than go in that direction. But certainly, if that were to happen, it would be a step towards what you've just mentioned. I don't think we'd immediately see a big negative reaction in the market, but I do think that it would certainly be a step in the wrong direction. Because just to highlight one point that I think is often not recognized, that French tax revenue as a percent of GDP is the highest in the OECD. It's higher than the Scandinavians. It's higher certainly than
even
the
than
UK.
Here?
Even than here. Actually, the UK doesn't show up that badly on that list.
All right, Nicholas, great to have you with us around the table this morning. This early morning, Head of Economic and Investment Research over at Intermediate Capital Group, we thank you. Coming up on the programme, we'll look at our stocks to watch as ABB announces plans to sell its robotics unit to SoftBank for $5.3 billion. More on that deal and your other stocks to watch next. This is Bloomberg.
Twelve minutes ago until the opening trade here in Europe. This morning, we have something special for you. Verisure is going to be IPOing a little bit later on. We spoke to the CEO just a few minutes ago. There is going to be a bell ringing. A bell is going to be rung, and we will hopefully bring you that bell ringing live as the market opens this morning. I don't think there's enough of this kind of thing. We need more bell ringing. Do we need more IPOs?
More IPOs, more bell ringing. 13.25 euros a share. That's the price it has gone for, isn't it? So we'll see how it trades in relation to that. I feel like there might also be confetti and things falling from the sky.
Apparently fireworks.
Maybe even real fireworks, although that sounds hazardous.
Inside fireworks, kind of when somebody says inside, they're not. It's going to be kind of maybe underwhelming expectations.
Is this a good time to mention we've actually had a few IPOs in London happening at the moment?
being announced,
a trio
at least.
of them. Yeah,
Yes.
I was speaking to the LSE CEO Julia Hoggett, who was very upbeat, very defensive actually about the IPO pipeline.
Well,
in
you
London.
asked her if she was going to be bought as well, which probably didn't go down very well.
Oh yeah, because the Euronext boss told you that she might be, but she said no, we're not for sale. But you have actually got a few of them coming through, and I feel like we need to give credit where it's
So are we
due.
going to have so the next time you see her, fireworks, bell ringing, kind of confetti, things falling from the sky
Dame
is what's
Julia,
going to be required?
I'm up for ringing that bell when the opportunity
It's
comes.
an incredible collection of businesses that are going to IPO in London. One of those very scary-looking face masks.
Do you know, I prepare for this show every night wearing one of those.
Well, you speak with authority on the subject.
Is that why the bag... so Lizzie has this enormous suitcase that she travels with, and now I'm beginning to understand why. You have to take all kinds of kit and caboodle with you.
But maybe we're distracting from today's IPO, which is the Verisure IPO. I was asking myself, everybody knows either has security equipment attached to their phone these days, or knows plenty of people who do. And I was asking myself, does this make the population, make the world feel like a safer place, or does it add to our anxiety about the world?
I think you know the answer to that question. OK, let's figure out what is happening in the wider market. We're obsessed with the IPO story. We'll ring a bell in just a moment. Our executive editor for markets, Mark Cudmore, joins us now. I'm sure he's excited by this event as well. Probably more excited, though, by the fact that gold is through 4,000. Mark, what's next?
I am excited by gold. I'm excited about what's happening on the stock side. I'm also excited about what's happening on the French side at the moment. I think there's a little bit of nervousness creeping into the market. Not on the gold side, clearly. That's one of the most consensus trades out there. Anecdotally, I'm hiring at the moment. Whenever I interview any candidate, their top trade seems to be bullish gold. So it's definitely completely consensus out there. But I get why. We're seeing a debasement trade. We're seeing an underminement of fiat currency. We're seeing an attack on institutional credibility. I can see why gold is such a popular trade. When it's so consensus, it's a little bit worrying, but it's hard to fight against it. On the flip side, what I think is probably where there is nervousness in markets is back to the idea of fiscal concerns. And I think we've had France and Japan in the radar this week. France will stay on the radar today, very much so.
Yes, so fiscal concerns. We're also concerned about the tech sector. At least in the last 24 hours, Mark, we've rediscovered our concerns around valuation, around ballooning AI spending, the circularity of some of the deals being announced. Is there anything new in this? Any cracks that you think could sort of linger in the market psyche?
It's a very hard one. I think it's very tempting for people for the last few months to kind of go, hey, these stocks are overvalued and it's a bubble. And I think we all have been talking about that for months, and we know that. Just where we are on this bubble, where are we on this parabola of kind of gains? I am still worried that we're kind of at I won't say early, but we're on the way up. Now, on the way up in bubbles, you sometimes get increasing volatility. That doesn't mean it's a straight line up. But I'm not sure that we're going to see the catalyst just yet to pop this bubble. I think we only see that when we start getting realization that we just won't get the revenues to justify the incredible capex. And that might be a quarter to away. But maybe what we're seeing on the sentiment change, what we're seeing in terms of what Oracle said overnight, what we're seeing in terms of those circularity stories of all these big AI-themed companies all investing in each other, is that we're going into the more volatile stage. So it's the latter stage of the bubble, perhaps. It's the beginning of the end rather than the end of the beginning. Have I got that the right way around?
But Mark, as stocks start to stutter, as gold tops $4,000 a troy ounce, you say there could be a case for a year-end dollar rally?
Yeah, very much so. And I think this is one of the things, even gold is the most consensus trade, and I completely get why. I am loath to jump on the gold bandwagon here at these levels, because of the two biggest dynamics going into the kind of marginal gold value are real yields and the dollar. And I do think the dollar is ripe for a bit of a year-end rally, mainly because its main competitors around the world are all being undermined. That's the euro, that's the yen, Canadian dollar. So all these key currencies, there's fresh bearish reasons. So dollar will rally by default rather than its own strengths.
OK, Bloomberg Markets Live Executive Editor Mark Cudmore. You can read that thought of Mark's on the MLive blog. Go to MLIV Go on your terminal. But let's get to your stocks to watch now with Chloe Melly. Chloe.
Good morning, Lizzie. We're starting to get some of the first few guidance cuts of this earnings season, and today it is BMW that just lowered its outlook on the back of tariff costs and quite weak sales in China, where it's been really struggling to compete with cheaper Chinese car makers. It's actually been outperforming its peers, Volkswagen and Mercedes, but we'll see how much this changes at the open. Of course, the market usually is not too keen on those big guidance cuts. Bloomberg Intelligence analysts said that this is unlikely to be the last of those profit warnings as well in that car making sector, so something to watch out for as the earnings season progresses. Moving over to some M&A action after ABB agreed to sell its robotics arm to SoftBank for an enterprise value of $5.4 billion. So this is a different plan than the one that was originally discussed, which was a spin-off of the business as a listed separate entity. So we'll see how this kind of big strategic move from the new CEO, who started just about a year ago, will be reacted to this morning. The shares have been really resilient, so let's keep an eye on that today. And finally, let's look at UK banks after the UK financial regulator gave more details about how much those banks should be liable for compensation to people who were mis-sold car loans. So now customers will get about £700 in compensation rather than the estimate previously of about £950. So this should give some relief. Let's keep an eye on Close Brothers in particular, given its massive exposure to that motor finance probe. It's been struggling a little bit there.
Chloe, thank you. Our equities reporter, Chloe Melly. A busy morning, as she says, plenty of corporate news flow. We'll also keep an eye on what's happening with French markets as well. We understand that the French outgoing Prime Minister, that is Lecornu, he's going to be speaking at 9:30 a.m. Paris time, so that's 8:30 UK. That's in the next hour of this programme. That's ahead of the final day of talks. He was given until Wednesday evening, of course, by President Emmanuel Macron. In the short term, though, we deal with the market open. We'll bring you that next. This is Bloomberg.
Good morning. They're ready in Stockholm. The bell is there. I've seen the bell. They're ready to ring it. We've talked about the Verisure IPO. We've already talked to the CEO of that company. He's there on the screen, waiting to get ready to ring that bell. We will bring that to you live as it happens. It's not often you get the audio effects of the bell being rung here in Europe. This is an opportunity that should not be missed. Yesterday looked a little bit like this. We definitely got a fade stateside. It was mainly on the back of the Oracle story, the fact that the margins there on the renting out business of the Nvidia chips looked razor thin, and the market certainly took fright to that. We faded that. Actually, you did see a little bit of a bounce in the Oracle share price, quite a decent bounce in the Oracle share price off the lows. But we finished near session lows, and I'm not sure how much of a read across, therefore, there is going to be into Europe this morning. And therefore, I think probably Lizzie's futures look fairly quiet.
Indeed, it's not the most exciting picture I have to offer you on the futures screen this morning, Guy. We are feeling a bit of that fatigue from yesterday in the US equity session that bled into the Asian session earlier, bleeding into European stock futures this morning. But a little bit of upside when it comes to CAC 40 futures. We're going to be hearing from outgoing Prime Minister Lecornu in Paris at 8:30 a.m. London time. So we are recovering slightly from the lows that we saw after his resignation on Monday morning. But lots of individual stocks to be watching this morning.
Yeah, absolutely. We do have some individual stocks to watch. BMW certainly in focus. Lizzie, we've seen the business cut the guidance. Weak China sales, tariff costs are in focus there. ABB also in focus because of an asset sale. And UK lenders in focus after we heard from the FCA, £11 billion worth of costs and compensation to be shouldered by the sector guy.
OK, here we go. It is time, A, for the market open, B, for the bell to be rung in Stockholm. Let's see if we can listen in to that listing of Verisure. Here we go. They are going to be ringing the bell. Here we go.
There's a lot of interest. There's a lot of appetite. And we're almost there. So 40 seconds to go. The countdown will be up here. I will expect everyone to participate. I will be checking.
Seconds to go. I think they're a bit behind us. Maybe there's some sort of lag between here and Stockholm. And they're going to ring it a little later than we originally anticipated. I can tell you the European markets are opening in positive territory as we await the arrival of this bell. We will count you down. I'm trying to count down in my head to when that is going to be happening. 40 seconds in. I'm trying to see if there's a clock and whether or not he is going to be ringing it on time. Maybe it's a minute later than the market open across the rest of Europe. Here we go. Let's take you back. Here you go. The bell is going to be rung.
2, 1.
there's the confetti that Anna promised you. There may be fireworks. I'm not entirely sure. I think we should celebrate IPOs here in Europe. We're not seeing many of them, but when they come, they certainly come with a little bit of razzmatazz, which is great, and a bell ringing, albeit, I would argue, maybe a minute late than we originally anticipated. Let me take you back to the market open. Actually, a little bit of a pop coming through in Europe. The FTSE 100 is up by 0.3%. The Stock 600 is up by 0.2%. Despite the delay, actually, the DAX is coming a little later than originally anticipated. So here we go. We are waiting for the DAX to open. I'm interested to see whether or not BMW is actually the problem that is causing us maybe not to open this morning. Lizzie, what's happening on the sector story?
Well, if we break it down, we've got about half of sectors in positive territory. Energy's leading the gains at the top of the basket, up 0.7%. Bottom of the basket is tech, down 1.5%. So following on, as I say, from that US story yesterday, it fed through into Asia. But if you look at some of the individual names that Anna had flagged earlier, we're waiting for BMW, but UBS shares are up 0.4%. Fresnillo shares again up 3.4% as gold smashes through that $4,000 an ounce level. We wait for Verisure, but it's a pretty mixed picture actually across the European equity story this morning.
The Verisure shares rising 10% at the open, so raising more than that 3 billion euros that they had intended. This is a sizable IPO for London, isn't it? Interesting to look at what's going on in the banking sector as well. And we heard from the FCA last night that £11 billion worth of compensation and costs needs to be paid out and shouldered by the sector because of the mis-selling of car loans. Well, that seems to have gone down as a good story for the lenders involved right now, because I can see that Lloyds Banking Group is up by 1.9%, and Close Brothers, Chloe flagging that this was a business that was exposed to that story, Close Brothers gaining 6% at the start of trade this morning. So there had perhaps been an expectation that it could have been worse.
The two standout stories, though, this morning are ASML and BMW. In terms of the points losses that we are seeing, BMW is down by 4%. It is the second biggest points drop that we are seeing on the European market. Mercedes now maybe takes that from BMW, but the car sector is down. But the story that I've missed that is having an impact this morning is ASML. That stock is down. It originally gapped lower, down by circa 7%. It has now recovered some of that loss, but is still down by 3.36%. This after a US probe into China exports. ASML has been part of the US pressure that has been emanating from Washington for restrictions on kit to go to China, and ASML is now maybe this morning falling victim to some headlines around that story. So cars are down and down hard. Mercedes and BMW are both lower. ASML, though, is the big points drag that we are seeing.
Yeah, but autos now the bottom sector across the European basket, down 1.6%. BMW down nearly 5% off the back of that slash outlook. Should we get some analysis now? We can bring in Fabiana Fedeli, CIO for Equities, Multi-Asset and Sustainability over at M&G Investments. What a morning, Fabiana. Not just the excitement about the bell, but I wonder what the narrative is, the mood is for you. Is it fatigue? Is it complacency?
You know, we talked in the past that this market was showing investors having crisis fatigue. So many things are happening to conflicts. You have tariff wars, you have pretty fragmented politics, and yet you are still seeing markets on the rise. And at some point, you're due to have a stop and pause. But, you know, if you look at the dispersion that we're having in markets, there's still a lot of places where there is value and you can make alpha. OK, so you have to select carefully, but broadly, are you worried that there is a bubble coming in AI, that it's about to burst, and all this circular funding is something that we really should be worried about? You know, it's interesting. That is actually a question we get a lot from clients. And there's always a bubble everywhere as far as I'm concerned, because over the years you've seen it in different parts of the markets. There are areas of AI that are clearly more frothy. There is a lot of concentration, but the demand for AI and everything AI and the chips is huge. So, and if you look at the dispersion in results of some of the companies that are also involved in the AI ecosystem, they are very different. So there are still areas where you can make that return. You just have to be more careful.
You talk a little, good morning, Fabiana, you talk in your notes about crisis fatigue. It's easy to think back to April and we were all obsessed with tariffs and what that was going to do to markets, and that had a big impact on markets. What do you focus on when you think about crisis fatigue and the effect that that has on investors?
So actually, the crisis fatigue that we've seen among investors is quite rational because geopolitics don't really impact companies and stock markets unless they impact earnings. And this has not happened so far, as tragic as a war is. Unless it does impact those earnings, it does generally not have an impact on the pricing of those stocks. However, the step from crisis fatigue to complacency is pretty short, and we just have to make sure that we're monitoring that.
And the role of politics in stock picking seems kind of incredible right now. I mean, we've got into a world where, you know, all of the private sector seems to be fodder for the public sector in some way. So a guy was mentioning this ASML story this morning, which seems to be that a House China panel in the United States has said that the semiconductor manufacturers in China made sizable returns selling equipment to Chinese state-owned and military-linked companies. And we won't talk about the details of that particular story, but it's just a reminder of the way that politics can eat into the investment case for businesses that you might like for various technology, AI-related reasons.
Yes, and particularly as of late when governments are really looking into companies' regulation and there is a lot of increased scrutiny. But in the end, what really counts is the underlying demand, the ability to have innovation in your product, the ability to service your clients. And as long as the regulation doesn't hinder that, then some of the companies will continue to have on the longer term good results.
The problem at the moment is that you don't want to get out too early. You've got to be invested. This is a market that has the potential to go sharply higher. Cameron Cries, well followed on the Bloomberg. We're in the throw darts at a list of tech firms and make crazy money performance phase, which we saw in 2000, and equity markets continued to rocket higher well after everybody started saying that we were in a bubble and things are getting out of control. But you still made a lot of money beyond then. What do you tell clients when they say, should I get out now? What does the conversation look like? Because in 6 months' time, it may be the right call to get out now, but you just don't know because calling the top is really difficult.
When is now?
Yeah.
That is very true. Timing is everything. And by the way, I was covering technology in 2000, so
yep.
I know what you're talking about.
We remember it, and I may be scarred by it.
Indeed. Timing is everything, but getting in and out of markets, it never makes good sense for returns. I think at this point you need to focus on fundamentals. You need to look at the companies that you're buying into. You need to try to understand what the underlying demand is and look ahead 1-2 years what that demand is.
Can you do that at the moment, though?
Well, you know, AI is a long-term secular trend.
But most kind of big investment cycles have a boom phase and then a big bust phase, and then the utility of the assets becomes clear after that, and you can buy in at reasonable prices, at prices that make economic sense.
That is very true. But if you look at some of the biggest players during those years that we were talking about, they are now at much higher market caps.
Some of them don't exist, though.
And some of them not exist. And why? Because their fundamental businesses were not able to test.
And you think you have the level of specificity required at the moment to understand which ones are going to win and which ones are going to lose?
You have no choice. You have no choice but to do a lot of research on these names. I mean, I think many asset managers, as ourselves, have really increased their research capabilities to do so.
When you come back to the when is now question, you could ask it for gold. When is time to stop seeing upside for gold? We've got so much uncertainty going on. We've passed that $4,000 a troy ounce level. Fresnillo this morning up 2.4%. Do you see more upside for gold from here on out?
Well, that's part of the narrative of let's try to diversify away from the dollar and away from treasuries. And gold is one way, by the way, digital currencies are another way, particularly for the younger generation of investors. But if you look at the holdings of gold, for example, among central banks, there's still some very large central banks in the world. Think about the PBOC, think about Japan. They still have gold as a percentage of forex reserves in the low single digits. So technically there is more room for gold, but it will also all depend on what happens happens with the faith that investors have in the dollar, and also any concerns with broader markets.
Yeah, talking about faith in the dollar, and you mentioned crypto and how some younger generation and others might be looking in that direction. JP Morgan's talking about how the dollar will be supported by stable coins. Is this part of the dollar's fight back to regain some of its lost status, perhaps?
Well, I think the Genius Act also aimed at supporting the, if you want, the near end of the curve in the U.S. and of the yield curve. So if that is what the result will eventually be, it should also support the dollar. But there are other forces, right, that actually are balancing that direction. And let's not forget the starting point. A lot of foreign investors were incredibly overweight U.S. assets of all kinds. And so there's still a move to diversify, not to run out of the door, because there's really no other market that can replace, particularly from a currency standpoint, the U.S. dollar. But definitely there is a move towards diversification.
Maybe diversify into European assets, which takes me to my final question. How are you feeling about France this morning? We're 18 minutes away from the outgoing French Prime Minister giving us another update on what is happening. Do European assets, what is the effect of a political crisis in France on European assets?
How many political crises did we have in Europe?
There are many.
Look, politics always create news flow, and it does create some level of volatility in markets. But in the end, is really what happens out of those politics that is going to impact companies and their earnings. So what will really be important is what happens with the French budget and what impact could have on domestic demand and domestic companies.
And what do you think?
It's, you know, I've learned that I can't really guess any of this, but obviously you have to be cautious.
Okay.
Well, if most of the euro's appreciation is behind us, couldn't that benefit earnings this season?
The euro appreciation overall?
Yeah, because of the French instability.
It does to some extent, to the extent that it will really have an effect on the euro. I'm not really sure that right now the French instability is having any significant effect on the euro. I think the other forces, I mean, think about infrastructure spending, think about defense spending. Those are other forces that are possibly helping the European market going forward.
Nice to see you. Thanks for talking about CS. Fabiana Fedeli, CIO for Equities, Multi-Asset and Sustainability at M&G Investments. What's the core six looking like this morning? ASML is a standout story to the downside. It's actually recovered most of the earlier gap lower. As you can see, we're down by 2.64%. This relates to a US probe into China business. That stock is down and stands out as a big drag on the market. The car sector is lower as well. Elsewhere, though, luxury reasonably balanced. The defence trade is back on. Schneider's up a little bit, which is interesting. But you are maybe seeking safety in healthcare this morning. Let's talk about what's happening with UK banks as well. We need to focus on what that narrative looks like this morning. Chloe's here with the details.
Good morning, guys. So, yeah, some positive movement across those UK banks, Lloyds and Close Brothers this morning after the UK financial regulator gave a bit more detail on how much those companies will be liable for compensation to people who were missold car loans. So we're talking about actually £11 billion in costs, which may seem like a lot, but this is actually a positive story because this is lower than what was expected. And it marks kind of the end of that motor finance saga that had been really hobbling the shares of those companies throughout 2024. In particular, Close Brothers, that was particularly exposed to that probe, and it is up 3% on the back of this morning. Moving on to BMW, we've got a little bit more of a negative story there. BMW cut its guidance on the back of tariff costs and weak sales in China, continued weak sales in China, as it is continuing to really struggle to compete with cheaper Chinese manufacturers. So we see that really driving the stock down this morning. We're down 2.7% on the back of that guidance cut there. Moving on to Umicore. Umicore is a materials technology company. It is up 7% this morning after starting the sales of its permanent gold inventory. So that's really driving the stock this morning for Umicore. And finally, let's talk about ArcelorMittal, the steel company. It was placed on positive catalyst watch at Citi. The price target was raised to a street high. And that is because the European steel industry might be turning a corner, and that is because of the EU's plan to restrict those foreign imports of steel. And that will be really supportive for ArcelorMittal. And on the back of this positive catalyst watch, we have got the stock up 3.4% this morning.
Chloe, thank you. Chloe Melly from our equities team. Now, we have been watching this and highly anticipated IPO taking place in Stockholm, and here is the share price. It is up 13%, 13.8%. Verisure listed at 13.25 in terms of euros price per share on IPO day and popping at the start of trade. That's the good side of the ledger this morning. On the downside, we have technology and we also have autos. BMW shares falling after the German automaker cut its financial guidance for the year. We'll bring you the latest on the sector next. This is Bloomberg.
I think it comes down to the quality of the asset and the length of the track record. I mean, we've partnered together, for more than 11 years. I mean, over that decade, we've actually tripled the size of the portfolio. We've quadrupled the revenues. We've quintupled the profitability. So it's not a short-term story.
Yep.
That was the Verisure CEO, Austin Lally, speaking to us earlier in the programme before he rang the bell in Stockholm before that IPO. And the share price is currently at 15.20. It had listed at 13.25. So it's a happy open for Verisure this morning, guys.
Absolutely. Well, we talk about the long-term prospects of this business. We don't want to talk about a pop. Pop's nice. Nice to have a pop on day one. Let's talk about what UBS is doing this morning. The share price is actually a little higher this morning. There's a number of stories swirling around UBS this morning that I think are worth paying attention to. Bloomberg has learned that the bank has shelved a risk transfer deal for $2.5 billion of loans. There's also a story in the FT, which we'll get to in just a moment, relating to UBS O'Connor and what is happening in terms of the financing around some of the failed auto debt that we're seeing in the United States. Let's talk about all of this. Our EMEA managing editor for finance and investing and legal is Tom Metcalf. He joins us around the table. Let's start off with the risk transfer deal. Why is it not happening, I guess, is the key question that everybody's trying to figure out. And how significant is this that this isn't happening?
Yeah, it's really interesting. It's not happening because the market itself is so hot right now, and we're just seeing deal after deal happening.
Yeah.
So that's absolutely something we're trying to work out. Normally, in this case, it's probably some disconnect between, buyers and sellers. Perhaps, UBS looking for a better price than people are willing to give. But it is interesting because, it's not unsizable. It's on those 2.5 billion of loans. It's very helpful.
Why would you do this? What will be the motivation to do this? Just to kind of explain the context and the background to this.
Yeah, so these things are very powerful for almost like streamlining your capital requirements or sort of easing that, because you effectively move them off your balance sheet in such a way that you don't need to now think about kind of the capital sort of setting it aside. So that's why banks are doing them, really keen on them. And, it's the hot new thing, I suppose, or the hot old new thing. But yeah, no, very curious. All we've been writing about is how these deals have gone through. So it's interesting to see one that didn't actually pass muster.
How do regulators feel about SRTs then, Tom? Because, you're taking risk off the balance sheet of a bank and you're passing it on to others in the financial system, and that means the bank can go out and lend more, which might be the role of a bank, which is great. But on the other hand, do lenders worry about the real state of a balance sheet?
Yeah, absolutely. It's one of those topics they're looking at closely, and particularly when there's such momentum behind a space, right? It's sort of, can we make sure we're keeping up with the market? And, it's definitely a useful tool and, one of the things that banks love to deploy. But, I guess when you look at the market doing something, I think Santander came out and said we'll do 45 billion of these this year and probably next, just shows what the appetite is. And whenever you get to that moment, definitely regulators start to think, well, we better make sure, there are no sort of hidden risks here.
And Tom, Guy mentioned this FT story that a UBS fund has a chunky portion of its portfolio tied to the failed First Brands group. What do we actually know about that?
Yeah, it's sort of a sign just, how much demand there is for private market things. And this is one of those indications where when it goes wrong, look who's exposed. So, yeah, we understand, the exposures at UBS O'Connor. And also another is Hedge Fund Solutions Group. That's pretty big. So in total, it's about $500 million. Yeah. And, the big thing there is, that is rich clients presumably ultimately going to hold the bag on that.
The critical thing about this, to my mind, is that this all needs to be seen against the background of the Swiss regulators trying to force UBS to carry more capital, which speaks to the SRT story and also speaks to the UBS story. Is the aggregate of all of this going to be that maybe the Swiss are less inclined to give UBS a little bit of a pass here? Is it going to make UBS's job harder to get that lower regulatory requirement over the line. The Swiss are going to go, look, yeah, you're still making bad decisions and you're still struggling to get some of this risk off your balance sheet, and we don't know where the risk is going. Is that the context we need to see all of this in?
I mean, I think for UBS, that's the context it has been for several years, and it probably will be going forward, which puts them in a tricky position, because you're absolutely right. Like, you know, maybe it has nothing to do in terms of, you know, the day-to-day decision-making, but if you're a Swiss regulator, you're watching every single thing UBS does, and for sure, you know, stories like this, you know, may well change that dynamic slightly. I mean... Everything's at the margin. Exactly. So it's a fascinating tale, and the way it's going to unspool over the next real years is something that's probably going to, you know, be a lot of careful management on UBS's part, I suspect.
Tom, thank you very much. Thanks for bringing us the updates on Metcalfe there on the UBS stories that we're watching. Let's go to the auto sector. BMW under pressure this morning. The share price down by 5.4%. BMW has lowered its financial guidance for the year due to persistently weak sales and the tariff-related costs, those weak sales in particular in China. It comes as another blow to Germany's export-reliant auto industry. Let's speak to Bloomberg's EMEA Autos industry team leader, Elizabeth Berman. Elizabeth, very good to speak to you this morning. So why are Western manufacturers such as BMW losing ground on sales in China? Because that seems to be where the focus is for part of this BMW story.
Yeah, absolutely. BMW is certainly not alone in reporting disappointing numbers in China. Mercedes, Porsche are very much in the same realm. And it's due to, as we know, the Chinese manufacturers catching up massively and offering attractive EVs, and not only that, in part for the middle market. But they're also offering their vehicles at really, really attractive prices. Vehicle makers like BMW have said they're not going to go with these sticker prices that some of the Chinese manufacturers are offering, and that's the result that we see here. They've lowered their expectations.
Well, speaking of more attractive pricing, Tesla, of course, Elizabeth, yesterday unveiled that cheaper Model Y, under $40,000. What does that mean for Europe?
Pardon, say that again?
What does it mean for Europe?
I mean, Tesla has been very successful in Europe in terms of its models here. For some years, they were definitely leading the sales charts for EVs. And they are getting a much more competition, not only from some of the Chinese manufacturers that are also trying to get into the European market, but also the likes of VW, Stellantis. They are starting to offer attractive models, and that's clearly targeted to compete.
OK, Elizabeth, thanks very much indeed. Elizabeth Berman joining us on the auto sector, the clear loser in today's trade. It's interesting that ASML's coming back a little bit now. I want to take you to Paris. This is the live shot that we are getting out of Paris right now. Interesting to see the European Union flag next to the French flag. That's going to be a critical relationship, isn't it? Anyway, Lecornu, the outgoing Prime Minister, is about to speak. The deadline, the 48-hour deadline that he has been given, is about to expire. We understand there's going to be talks today with the Socialists. We get a pre-meeting update. What is he going to say? We will bring it to you live. This is Bloomberg.
This is the opening trade. We're 30 minutes into today's session, and under the hood, there are lots of negative stories swirling around. You wouldn't know it to look at this picture, but BMW narrowing its margin forecast, ASML knocked by that US probe into China exports. But look, the DAX still up nearly 0.2%. The FTSE celebrating, the miners in particular, celebrating gold passing that $4,000 a troy ounce mark, and the CAC 40 up as we wait to hear from the outgoing French Prime Minister, Sebastien Lecornu. Guy, what are you watching under the hood?
Let's take a look at the internals, figure out what is happening with this market. You've got 335 up, you've got 249 down. It's a reasonably balanced market. You're not seeing a big kind of skew one way or the other. In terms of the volume, it's reasonable. We're up on the last 20 days. Let's talk about some of the 52-week highs. We are seeing some gains today, which is really interesting. ArcelorMittal is tracking higher on an upgrade. You got ASIA Brown Boveri up by over 1% this morning. It is going to be offloading its robotics division. You're going to see that being bought by SoftBank. interesting when SoftBank gets involved. And you've got Lloyds Bank in the UK. That stock is up by 2.67. We saw the details coming through yesterday afternoon, already priced in to a certain extent, relating to what we are going to see on the motor finance charges that are going to be made. The sense seems to be it could have been worse. And that is why maybe you're seeing Lloyds trading at a 52-week high today. But there's plenty of other stock stories out there in the market this morning that we need to focus on, plus also an awful lot of politics going to be happening over the next 24 hours. Anna, that takes us straight to what is happening in France.
Yeah, absolutely. So we're monitoring these live pictures coming to us from Paris. The outgoing Prime Minister of France, Sebastien Lecornu, is due to speak. We understand he's going to be speaking today. The deadline is not until this evening. So Emmanuel Macron, the president, gave the outgoing Prime Minister this deadline of this evening to bring together the opposing parties to try and give France some stability, some way forward, to try and agree on a budget. So it seems unlikely that we'll hear from the Prime Minister any conclusions right now, but maybe just setting out the stakes once again. We heard from him earlier in the week, though, when he resigned his position initially. We heard from him about his disappointment with the various parties involved in the way they had not managed to come to any kind of consensus. Perhaps that will remain the story today, but perhaps, Guy, he's going to set out his stall this morning and then proceed to some of the negotiations, which, as you've been mentioning, might involve the Socialists, might involve the left, might involve talking about a signature policy of the Macron period, which has been pension reform.
Pension reform, absolutely front and centre when it comes to the Macron administration, but now apparently in play, which tells you maybe how desperate the Macron presidency is now feeling about its route forward. 2027 feels like an awfully long time away. In some ways, the debt narrative is kind of the overlap with what we're seeing over in the United States. France, the UK, many other countries around the world, including the United States, struggling with that narrative. And it takes us, therefore, to what we're seeing in terms of the stalemate in Washington, D.C. President Trump is threatening to block now back pay for some federal workers once the government reopens, saying some, quote, don't deserve to be taken care of. The White House Budget Office has drafted a memo arguing the 2019 law guaranteeing back pay is flawed and doesn't require automatic payment. Democrats calling that interpretation, quote, an outrage and a clear violation of that piece of legislation. Joining us now to talk about the wider picture, Aditya Bave, senior US economist at Bank of America Global Research. Good morning. Nice to see you in London. How are you doing without the data? What are you seeing in terms of the US economy right now? How big a struggle have you got on your hands?
Yeah, we're hanging in there. So basically what we have without the official data is a few pieces of a very large puzzle. So we have some sense of what the picture is, but we definitely don't have the whole picture.
So what do you think? What does your gut tell you about what is happening under the hood right now? Because I'm seeing a lot of conflicting evidence regarding what is happening, particularly with the labour market. That is that's what we're really looking for here, to try and get an understanding. I'm seeing private sector data that's telling me that payrolls could have been anything from kind of 0 up to around 60,000.
There is this fascinating conundrum in the U.S. economy right now between a robust consumer, not just a consumer that's hanging on, but strong consumer spending versus
feels like it's
a labor market
consumer, but
labor market that's really quite soft. And ultimately, the two are going to move together. It's just a matter of which is going to converge to the other.
But when you think about the US government shutdown, does it make an October cut from the Fed more or less likely? You've got, as Guy says, you're flying blind data-wise, but then the weight on uncertainty on confidence.
I think the way the Fed communicated in September, the onus was going to be on the data to take an October cut off the table. So without the data, I think it's more likely that they will cut, and we are expecting them to cut in October.
OK. And then when you have those cracks in the labour market showing, even if we're only seeing them from the private surveys, do we have to take Stephen Myron's lonely dot more seriously?
So what I would say is that the Fed is kind of balancing the inflation and labor market risks. If inflation were at 2%, that would be a much easier case to cut right now. But inflation slows it at 3%, and even if you take out the estimated impact of the tariffs, it's probably around 2.5%. We've been stuck above target for over 4 years now. So all of that, I think, puts the Fed in a position where they need to take the risk to both of their mandates in opposite directions quite seriously.
Aditya, that sounds like quite a traditional Fed. Is that the way you're viewing this? Or has there been some sort of structural shift in the way that we think about the Fed and its reaction function?
I think it's a pretty traditional Fed, to be honest. Chair Powell has kind of stuck to the message, regardless of whatever is happening with politics. He's been very clear that the data will guide the Fed's decision. And I think this also matters for the December decision. We don't have a cut in December. And Powell suggested that this could be the first of a series of cuts, but we'd also point out that Powell is very, very data dependent. He's not going to care what the dot plot said or even what his dot was in September come December. He's only going to care about the data, and there's 3 jobs reports.
Aditya, can I just hold that thought for just a moment? I just want to take everybody to Paris. Lecornu is just started speaking. He's going to be speaking in French, so we're going to sort of provide you with some heads. But just a kind of an interruption to the conversation on what we are seeing in the United States. This is obviously ahead of the end of the 48-hour deadline that we are seeing imposed by Emmanuel Macron. But we're waiting to see kind of what the last day of talks is going to bring. There's a sense out there maybe the pension reform is on the table, and that could be maybe the last kind of throw of the dice that we get from the kind of the Emmanuel Macron era.
Yes, absolutely. And so the pension reform that was passed increased the retirement age from 62 to 64, and this has been for a very long time under Macron a point of tension with the left in the Assembly. And so if we were to see that the government is prepared to make some sort of concession on that particular flagship policy and roll back any of that, then that would be quite substantial. What would that do to borrowing expectations? What would that do to bond markets? Would be interesting to watch. And it's interesting in itself that actually yields are quite stable this morning and bond markets are quite stable this morning. The French spread of France OATs over bunds is at 80. In fact, it's dropping. It's at 83.7. It's not, it's been at 85. It's not expressing very a sort of point of anxiety right now.
How do you get the deficit down if you can't do pension reform? How do you get French finances under control if the kind of centrepiece of your policy is tossed at this point? You do wonder if they deliver this, what the market will say. Are cuts possible? Is spending restraint in any way feasible in France without a major political shift?
And is it possible, I mean, is it possible to get any of the parties in the French National Assembly, well, to get them to agree on any kind of budget? How can they be motivated to do that under a Macron presidency, or is that going to be the stumbling point?
You have to answer both questions with the answer of a wealth tax, the Socialists and a wealth tax.
Well, I think, or do you have to answer those questions with presidential elections? Let's clear the political impasse. The Macron administration has effectively kind of lived in a world where it's not recognising reality for a long time now, and
Which, as you say, is a global problem.
Well, it is to a certain extent, yes, but the French are at the epicentre of this. The UK, you could argue, is within that storm as well. There's a political reality which he is not recognising, which is he can't do anything with the current parliamentary setup. Do you need to clear that, or do you actually need to clear some of the details around the presidency?
And indeed, so far, what we've heard from Lecornu is that there is a shared will to have a budget by the end of the year. That seems extremely hopeful, but the hope is being taken by traders this morning. As you say, Anna, the oats spread narrowing to 84 basis points at the moment.
Yes, so those words getting to the bond markets, which is interesting in itself. Let's get back to our conversation with Aditya Bave, who's with us. You'll focus very much on the US, usually, but clearly taking in a global, with a global backdrop. And we're focused on France this morning. That's not the only place in the world where we have difficulties, tensions with getting the books to balance. From your US standpoint, how do you watch this story evolve in France?
As you said, it's a global problem. Deficits are certainly a challenge in the US. Tariff revenue has helped keep a lid on the deficit, but obviously the risks are now that the IEEPA case is going to the Supreme Court. There's a risk that those tariffs might be deemed illegal, in which case we'll have to see what the next step is for the administration. The only thing we'd point out right now is that the tariffs are raising 1 to 1.5% of GDP on an annualized basis. So if that revenue goes away, you could be looking at a deficit of 7% rather than 6%.
Do you think bond vigilantes globally have been quite calm, given what we've been seeing in the United States, in France, in the UK over recent, certain periods? Do you think bond markets actually have been quite calm?
We've had a few bouts of bond vigilantism in the US, but they faded fairly quickly. The most significant recent one obviously was after Liberation Day, but it seems like right now the markets are okay with a 6%-ish deficit, maybe going into the 5s in a few years. if we go back towards 7%, then the story might change.
Just noticing some of these moves in reaction to Lecornu, we have the CAC 40 up 0.4%. So really liking what he's got to say.
But he's saying deficit target for 2026 should be below 5% of GDP. Yeah, OK, that's great.
We know.
How? How are you going to do that? He's just finished speaking, and I'm not sure, actually, we've got much detail. This is the objective. Fantastic. How do you do it?
Well, we are going to hear from him by the end of the day, he says. He plans to present solutions to President Macron by the end of the day. So the how is coming before that deadline.
I'm interested in that line where we quoted this, and it does seem to be what has had an effect on bond markets. Shared will to have a budget by the end of the year. Is he reflecting that there is a shared will, or he has shared his will? I'm not sure how much we really coalesce around one.
Meeting with the left to hear the concessions they want. The ball is in the Socialists' hands. Do they support the government? Do they not support the government? What do they require to support the government in this? Is it going to be pension reform?
Do they require their own person to be the next Prime Minister?
Yeah, so precisely. What is going to be on the list? We're going to find out by the end of the day, but it does seem as if we are seeing French yields are down, the stock market is up on the back of what has been said thus far. He is setting out a positive stall rather than a negative stall. By the end of the day, this feels like it's going to be a very short day in politics in terms of, or a long day in politics, depending on your point of view. Anyway, we will continue to monitor this and watch what is happening. It's going to be fascinating. At the end of the day, it's going to be really interesting. We'll come back to it. Aditya, I just got a couple of quick questions that I want to ask you. You talked about the consumer confidence story a little bit earlier on. That feels like it's being supported by the stock markets at the moment, or asset price inflation that we are seeing more broadly. The upper echelons of society are spending much, much more as a result of maybe that narrative. How connected is the AI bubble, the stock market, consumer confidence, and therefore this kind of division that we're seeing between the labour market data and what we're seeing on the consumer confidence front?
I think, as you suggest, it's all tied together. So there is evidence of an equity wealth effect, even if you look at our internal data. So this would be aggregated and anonymized spending by Bank of America's credit and debit card customers. There's evidence that higher income folks are outpacing lower income folks in terms of year-over-year card spending growth. That said, I don't think it's just a matter of the run-up that we've had in the last few months in stocks. It's a matter of what's happened since the end of 2022, where the Nasdaq is up more than 100%.
I guess what would happen if it came down?
It would have to come down a lot, and would have to come down for a sustained period. So if you look back to April and May, we were looking for wealth effects in the opposite direction when markets were down, and we actually didn't see it. And I think it's because the sell-off wasn't large enough and it wasn't sustained. Correct.
Aditya, just looking ahead to the Fed minutes later on today, you mentioned about how the risks are balanced on both sides of the ledger. I mean, do you think that these minutes are going to be more hawkish than we had the sounds of Powell in the press conference after the decision?
So the minutes, I think, are going to reflect a very, very divided committee. It's kind of interesting because they've coalesced on a macro base case that's even more hawkish than in June. And yet they're saying, at least the median is saying, that they want to cut more than in June. So it seems like some of them are more scared than others about left tail risks. Maybe they think they're more likely, or the left tail is more scary than others, but that's where the division is on the committee. And there's also this question of how much of the slowdown in the labour market is because of supply versus demand. So the next 3 prints of the unemployment rate are going to tell us a lot. And I think that will determine the fate of potentially the December cut or no cut, and also policy early next year.
I wonder if in the minutes normally you get reference to a few said this, many said this. Are we going to have one said this? Or not? You know, we'll see whether there is any. But
if you dissent, you don't get to have an impact on how the statement is written. So by doing that, you kind of remove yourself from that process.
Well, the statement, yes, but the views will still be reflected in the minutes.
Yeah, so we could get the one. I mean, we heard from Myron yesterday saying that his view is that monetary policy should be forward-looking, which is interesting because you get the sense from Powell and others that they are also looking forward at inflation effects that they see could still come. And even they admit they haven't seen them yet, particularly. So, I mean, in a sense, everybody agrees there needs to be a sort of forward-looking element to monetary policy.
Of course, monetary policy has to be forward-looking. The challenge is how much of your forecasts depend on the data that you're already seeing, and you're going to be more data dependent when there's more uncertainty about the outlook.
Thank you very much, Aditya. Thank you very much for joining us, Aditya Bave, Senior US Economist at Bank of America Global Research.
OK, quick look at French assets as we watch the impact of what has just been said by the outgoing Prime Minister, Lecornu. You are seeing yields coming down a little bit. You are seeing a narrowing in terms of the spread over Germany. He sounded positive, but he's going to speak again at the end of the day. This is kind of brief positive hiatus maybe we see in French assets. He's saying that there is a sense that maybe a deal does need to be done, but I'd say French politics are fairly febrile at the moment, and you do wonder whether what the Socialists will require may be a step too far. Anyway, CAC 40 is up by 0.4%. We'll come back to this story in just a moment. This is Bloomberg.
Welcome back. This is the opening trade. We're 49 minutes into our trading day, and we have a lot of focus on the French story right now. We've heard from the outgoing Prime Minister, Lecornu. He says there's a shared will to have a budget by the end of the year. Reducing the deficit is key to France's credibility. The deficit target for 2026 should be below 5%. He's going to be meeting with the left. He's going to be speaking to Macron, and he's going to speak to the world's media, to the financial markets later on today. He's saying things that the bond markets like, it seems. Jean Dalbar joins us at Bloomberg Economics and with analysis. He does seem to be saying things that, at least at the margin, Jean, the bond markets like, and we see a little reduction in yield as a result of this. But is there anything new in what we're being told here?
I mean, it's not really new, but we can see some light at the end of the tunnel. So it's pretty positive from that perspective. But it is not a surprise because he has been speaking with its previous majority. So it's not a surprise that they wanted to reduce the deficit. But the hope at the end of the tunnel is coming because we could expect the center-left to agree with the Prime Minister if the Prime Minister proposes to suspend the pension reform, which is a key element of the economic platform of the Socialist Party. So some light at the end of the tunnel, but it's not a surprise at the moment, and we will expect the Prime Minister to make some announcement later today.
Jean, what would be the impact in terms of long-term French finances of taking away this pension reform process?
So I guess it's a trade-off between short and medium term. On the short term, I guess it's more important to have a budget which is passed and to have a consolidation which is on track. But on the long term, it's a key risk for French debt sustainability because we have calculated that a reversal of the pension reform would increase the debt to GDP ratio by 15 basis points over 2050. So it's a large increase compared to baseline if the pension reform is reversed. But I guess having a budget passed is really important on the short term. And French politics could deal with a new reform of the pension system later after the presidential election.
OK, well, we'll wait to hear from Lecornu by the end of the day what his plans are and who he's been working with. But for now, Jean Dalbar from Bloomberg Economics, we thank you for the analysis. Now, we have one eye on the French political drama and the other on the US political drama. President Donald Trump escalating tensions with Congress over the government shutdown and saying that he might withhold back pay for furloughed federal workers. Speaking exclusively to Bloomberg, the JP Morgan CEO, Jamie Dimon, said he's no fan of shutdowns, questioning whether they'll ever have a real impact on markets or the economy.
Look, I don't like shutdowns. I think it's just a bad idea, and I don't care what the Democrats, Republicans say. It's a bad idea. It's not a way to run a railroad. I don't think it's critical. We've had, I forgot the number, 4 or 5 or 6. One of them went for 35 days. I'm not sure anyone really affected the economy and the market in a real way.
Now, Dimon went on to underscore the strength of the bull market and the importance of jobs.
Look, we're in a bull market. It's been clear. Asset prices are high. Credit spreads are low. Consumer's still okay. The consumer has jobs. Remember, jobs are what usually starts to force people to cut back and change things. And consumers spend less and companies cut back. So far, so good.
So, Jamie Dimon there. Let's bring in Bloomberg's Valerie Teitel for analysis. Val, we've had the president saying that he would be willing to negotiate with the Democrats on healthcare subsidies if they let the government reopen. We heard Dimon's view there. How's the market taking it all?
Look, I think the market is just sensing there really is no urgency in Washington to get things back open. And with that, we have a lack of data continuing again for a second week in a row. We're still waiting for an update on jobless claims. We're still waiting for an update on non-farm payrolls. And these things are really key, because what we're seeing in the market right now is the momentum trades are still continuing. There's really nothing to change the market narrative at the moment. We're still seeing tech stocks perform well. We're still seeing Bitcoin perform well, and gold as well. Another record rally for it today.
Are these two, are they isolated? Like, what is the connection between current market pricing and the shutdown, if any? Because it feels like they're on different tracks. So is there spillover from one to the other?
There will eventually be if the shutdown does last for a meaningful long amount of time. But I think what the market has learned from the previous shutdowns is that any hit to GDP will just be made up in the next quarter when the government does eventually reopen and these paychecks, if they do go
assuming that
to
people
those
get back
people's
pay.
pocket, exactly, continue. So I think the market is basically like it's seen this rodeo. It's definitely not the first time this has happened, and it's just penciling in fine. Maybe there's going to be a weaker quarter this year because of it, but the quarter the following will be fine. But the key thing really here for the market is the labor market data. We're still waiting on all of that. You know, we have various analysts from across the street still putting together their estimates for September payrolls. Some, as Carlisle have put out, are as low as 17,000.
Yeah.
So there's still a narrative in the market that this labor market is weakening, and with the absence of data, it's really hard to see the Fed changing the needle and changing the way that they've been communicating. And we can tie this in to the rally in gold, because if we look at really what spurred the recent move in gold since the end of August, it's been this pivot from the Fed. Jackson Hole that had led the market to price in 100 basis points of cuts in the next 12 months. That's really what's led this rally in gold. So it's hard to see that stopping if the Fed narrative doesn't change.
Right. So that's something we're watching. And so just as a reminder then, if we don't get jobs data, aside from Carlisle and everybody else trying to put together their own ones, if we don't get, then we get a cut in October, don't we?
That was what the market is assuming. Yes.
Yeah, and that is what, and then more into next year.
Well, look, it'd be hard for them to incrementally change their language without this data, so they'd probably very much toe the line of what they said previously. But again, you know, I think the discussion goes back to the bifurcation or the disagreements at the Fed. Maybe that will only be highlighted. You know, we've heard from Stephen Myron many times. He spoke to the press yesterday, saying that Trump's policies net are deflationary and the Fed still needs to cut. So that kind of division in the Fed will likely be increased in the lack of data.
Valerie, thank you very much. Bloomberg's Valerie Teitel. So we don't look ahead to any data out of the United States of any particular note. There's all the private sector stuff, but none of the government stuff. We do look ahead to further news on French politics. That is certainly going to be an area of focus for us. We've heard from the Prime Minister this morning. We've seen some appetite return for French assets at the margin as a result. Will that last? As Guy was asking earlier on in the programme. That is it for the opening trade. The Pulse is up next. This is Bloomberg.